Dear friends, welcome to Weekly View on Markets. This week, Nifty has consolidated in a range of around 400 points, that is 19,900 to 19,600 range. So the movement was sideways, and within this range, market was highly volatile during the week. And there were many quarterly results of leading companies announced during this week, and that was one of the reasons to sway the markets. FIs were net sellers during this week, but DIIs have bought more than FIIs and have supported the market levels. Technically, Nifty shows consolidation on the charts. We will see the charts later. This consolidation is quite healthy. After a few days of consolidation, markets are likely to test higher levels. I have a positive view on the markets, and my views are supported by improving domestic as well as global macroeconomic parameters, which we will discuss at the end. Now, let us look at performance of indices during this week. Nifty closed lower, not about 99 points, closed at 19,646, lost about 0.5%. Bank Nifty also lost about 1.32%, that is lower by 607 point, closed at 45,468. Mid cap and small cap indices outperformed the market. Lot of companies came out with good results, and markets reacted to the good results. That is how we have seen a rally in the mid cap and small cap sectors. Mid cap closed at 37,357, that is up by 557, closed with a gain of 1.52%. Small cap index closed at 11,600 with a gain of 71 points, gained about 0.61%. India VIX is at around 10.13. Now let us look at sectoral performances. Most of the sectors have gained during this week. There were more sectors which have gone up than the sectors which have lost. Realty sector gained about 5%. Surprisingly, a lot of real estate companies have posted a very good result. Pharma companies have gained about 4.82%. After consolidation of about 1.5 year, pharma sectors have started moving, and they have given a rally of more than 8% in this week. Healthcare sector also followed the pharma sector. They have gained again more than 4%. Media's sector gained about 3.45%. Metals gained about 3%. Energy stocks gained about 2.29%. Companies like BPCL, Indian Oil Corporation have posted good results during this week. Commodity sector gained about 2.04%. Infrastructure stocks gained about 1.95%. So infrastructure stocks also are giving quite good results during this quarter. FMCG lost about 1.37%. Information technology lost about 1.27%. Private banks lost about 1.02%. NBFCs lost about 1.15%. These sectors had run up a lot in last 2 weeks. So they have seen some profit booking, but there is nothing to panic about. Now let us look at technical charts. This is the daily chart of Nifty. As we can see, after a run up, the market has gone into some kind of profit booking and consolidation. Nifty touched the highest level of 19,991. After that, we have seen some kind of correction for about 5 6 days. This is a very healthy correction and consolidation. Market has support at around 19,600 levels, and Nifty has to take out the resistance of 19,900, and after that we'll see Nifty going to the higher levels. The overall chart structure looks quite healthy, and any dip should be used as a buying opportunity. This is a chart of mid cap index. The mid cap index has gained during this week also, and as we can see, the chart is in a very good uptrend. There is no sign of any weakness in the chart. So the Nifty mid cap index is also likely to maintain its momentum. And there could be few days of consolidation because it has run up a lot. This is a chart of Nifty small cap index. The small cap index is at around 11,600. As we can see, last 4 5 days, it is consolidating in a small range. And lot of small cap companies are yet to announce their quarterly results. Most of the companies in the small cap sectors are posting quite good results, and I feel that after few days of consolidation, then when Nifty small cap index takes out 11,600 levels, it will give a sharp rally, and finally it will move towards the previous high of 12,000 levels. So there is no weakness in the chart. Investors have to be patient. They should learn to live with the volatility in the market for a few days, and there is no reason for panic. Remain with your investments. Mid cap and small cap sectors are likely to give good profits in the coming months. This is the Bank Nifty index. So I personally feel there is still more upside in the Bank Nifty index, even though there is little correction. Bank Nifty index is facing stiff resistance at around 46,000, 46,200 levels. So this resistance level has to be taken off, and once that is taken off, Bank Nifty index is likely to go to 48 to 50,000 levels. I have studied the valuation of different indices, which I will discuss a bit later. So I feel that there is still opportunity in the banking sector, and banking index, that is Bank Nifty index, is likely to go to higher levels. Now let us look at some of the macroeconomic fundamentals of the market. India's macroeconomic fundamentals are quite stable and look uh, healthy at this point of time. That is why we see a lot of FII money coming into the markets. The FII investments have crossed 1 lakh crores, that is 12.6 billion into the Indian markets. So this is a benchmark level that has been crossed. So they are seeing good prospects and good growth opportunity in the Indian economy in the coming years. That is why they want to invest in India. So RBI dollar reserves is above 600 billion dollars. It is at 60.03 for this week. INR USD rate is at 82.06, and dollar index is stable at around 101.82. Gold price is again stable at around 60,380 level. It has been around this level for last more than 3 to 4 weeks. Crude price has slightly gone up. So this is one risk factor for Indian economy. From about 70 levels, the crude price has steadily moved up in last 3 4 weeks. We have seen 75, 76 levels. Now it has crossed 80 and it is at 84.75 dollars per barrel. So we'll have to keep a watch on the crude price level. If crude price levels keeps going up, that will be a red flag because we import more than 80% of our oil requirements. So our imports bill will go up. That will push down RBI reserves. Also, it will fuel inflation in our economy. SBI Research has published a report which they have told in this report that India will be the third largest economy by 2028. The largest economy will be US with around 30 uh, trillion dollar GDP, and next will be China, which will be around China will be at around 18 trillion dollar economy, and India is going to be around 5 to 6 trillion dollar economy, and we will be the third largest by 2028. But we have a large population comparing to the many of the developed countries. Per capita income in India still will be much lower than developed economies. This gives us more headroom for growth. So I believe that India needs to grow at 6 to 7% every year for next 10 to 15 years. Then only we will be really achieving per capita income of say $5,000 per person, like it is there in the other developed economies. So there is a good growth opportunity in India. So even if we become third largest, still there is lot of room for growth in Indian economy. That makes my view on Indian markets very, very bullish for next at least 15 to 20 years. IMF has raised GDP forecast for FY24 at 6.1 for Indian economy. RBI has given an estimate of 6.5%. So definitely India will be growing between 6 to 7% as per different estimates. There was a US Fed meeting, that FOMC meeting during this week. They have raised the interest rate by 25 basis points. And FOMC has told after the meeting that if US economy slips into recession, they are ready to help the economy and switch on to a more accommodative policy. Earlier, the Fed chairman had told that they are likely to have rate hikes by 25 basis points twice during this year. Already 25 basis points has been done. Another 25 basis points may happen or may not happen, depends on the economic situation in US. But the recession fears in US are slowly fading away. Even if there is a recession, it will be a mild recession. So that is good news for Indian IT companies and pharma companies which are exporting to US. European Central Bank has raised interest rate by 25 basis points, and the repo rate is 3.75% in Eurozone. The inflation in Eurozone has come down from a peak of 10.6% about a year back to 5.5%. So ECB has set a target of 2% for inflation, and they are likely to follow tighter monetary policy for few more months. The bond yields in India, that is 10-year GSEC bond yields, are in a downward trend, and interest rate swaps. India interest rate swap internationally has gone up by 15 to 20 basis points. So these two, the downward trend in the bond yield and the swap rates, indicate that RBI is not likely to raise interest rates in the near future because the inflation in India is coming down. RBI says it is within the RBI band of 6% and it is likely to come down. Chances of interest rate rise in India is remote. So this is giving confidence to the market. The lower interest rates or the stable interest rates are good for the economy and also for the stock markets. Government has said that they are likely to announce productivity linked incentive scheme for chemical and petrochemical sector. That is good news because most of the chemical companies have not been able to give good quarterly results. They are under pressure. The demand for chemicals and petrochemicals is lower due to the slowing global economy. Export figures are not good for these companies, and their margins are also under pressure due to the high commodity prices in the previous quarters. So the PLI scheme for this sector is a good move by the government. This is the valuation metrics of different indices in the market. Nifty is trading at around 22.91 price to earning and price to book value of 4.8, and mid cap index is trading at a price to earning multiple of 25.34 and price to book value of 3.22. Small cap is still after so much run up also it is at 21.76 price to book earning, price to earnings ratio and price to book value of 3.53. Bank Nifty is around 46,000 levels, but it is trading at 17.26 PE ratio and price to book value of 3.15. Out of this, private banks are trading at 18.8 PE value historical, and PSU banks are trading at 7.98 price to earning value. And price to book value of PSU banks is just 1.15. So looking at the valuation metrics, earnings growth and valuation indicate good opportunities in banking sector and NBFCs in the overall in the financial sector. Among these banks, PSU banks look quite attractive because they are trading at a very low price to earning valuation of 7.98 and price to book value of 1.15. This is just the beginning of the pickup in the earnings growth of PSU banks. So one has to be quite selective, look at their gross NPAs, net NPAs, and management quality, all these things. Then I feel it is good time to get into some of the good PSU banks. Mid cap and small cap stocks seems to be on the higher side of the valuation. Even though it looks that PE value of small cap is 21.76, the small cap always trades at a discount to the large caps. If we look at the historical PE levels, always small cap trades at a discount to the large cap. So at 21.76, small cap index is fully valued, and investors have to be cautious. But having said this, there are still companies having good corporate governance, good earnings potential, and trading at lower P values. Those are the companies the investors have to look at. Otherwise, if one is not able to understand these things, simply put invest your money through mutual funds. So, looking at overall various parameters in India and globally, as we have discussed, I am quite positive on Indian economy as well as on the stock markets. So investors have to be patient and they have to learn to live with volatility, and they should remain invested for longer period of time. And I am sure both mutual fund investors as well as direct equity investors will see very good time coming in next 2 to 3 years, and they all will be making good profits, good return on their investments. This is all for this week. If you like my video, please subscribe to my channel. You can give your comments. You can share the video with your friends. We'll see you next week. Thank you.